In his keynote address, Erskine Bowles just emphasized the importance of fiscal responsibility that he and co-chair Alan Simpson identified in their report entitled A Moment of Truth. Key proposals, including reduced discretionary spending, comprehensive tax reform, healthcare cost containment, reduced entitlements, and modifications to Social Security, were proposed to tackle a looming fiscal crisis. This morning's panel continues to underscore the challenges facing finance in a world of uncertainties, exploring specifically corporate finance in a world of uncertain valuations. In the past years, we have witnessed striking changes in corporate finance, involving both the sources and uses of cash. Non-financial U.S. companies are holding record levels of cash and short-term investments, totaling in excess of $2 trillion, one of many significant changes in how companies raise capital. There have been dramatic reductions in IPO and merger activity worldwide. Real investments like capital expenditures are at the lowest levels in years. How do you do firm valuation and activity underlying all of these key corporate financial decisions when government policy is especially uncertain, when growth rates are especially uncertain, when riskiness itself is especially uncertain? I've asked our panelists today to discuss the effect of such valuation uncertainties on corporate financial decisions. I will introduce each of them, with each panelist providing about 10 minutes of introductory remarks. After some follow-up, we'll then open it up to questions from the audience. Our first panelist today is John Moon, who's a managing director at Morgan Stanley Capital Partners, which is Morgan Stanley's private equity business specializing in buyout investments. He teaches advanced corporate finance at Columbia Business School, which applies corporate financial theory to cases of financial policy, financial instruments, and valuation. He received an AB, AM, and PhD in business economics from Harvard University. John is a member of the Program for Financial Studies Executive Advisory Board. John Moon.
Thanks, Laurie, and thank you all for your time. Laurie asked me to give some thoughts around IPOs in particular, but generally a discussion around public and private markets. My background, even within Morgan Stanley, is I'm a partner within the private equity fund, but along the way, in what's been over now a 20-year career, I've spent time both on the investment banking and the sell side of the business as well as the buy side. So I'll have some comments, as well as taking Laurie's overflow. I teach here at the Columbia Business School, Advanced Corporate Finance, and it's literally Laurie's overflow. So with that, I do get a chance to teach, though. So let me sort of spend and bridge. I've sort of been schizophrenic for about 25 years, bridging back between academia practice. So have a couple of thoughts around some of these broader issues. I guess one of the let's start with what we know about the public markets. One of the sort of the hallmarks, or one of the striking things, as a newly minted PhD, going to work for Goldman Sachs. I was an investment banker at Goldman Sachs. Coming out with my PhD, was just how different theory and practice seem to be at a fundamental level. And what I mean by that is looking at the public markets and the interactions and the frictions that seem to exist, that seem to be abstracted away from when you were studying the models and the theory in graduate school. And what I mean by that are, and these frictions are very large and very real, and that's why you have large institutions that are meant to address them. So let me give you an example. In the IPO market, you have set aside the investment bankers and the lawyers who charge their full freight, but you have 7% underwriting discount. You have, on average, it can be sometimes even bigger, but on average, statistically, 10, 15, maybe more, 15% underpricing. In other words, on the first day or two of pricing of these securities, you see, and investment bankers will tell you, you must price at a certain valuation and allow for the price of the shares to trade up. So if you think about that, you add up 7% plus 15%. In an IPO, if you're an entrepreneur and you're thinking about going public, every share that you raise has a 22% fee associated with, a cost associated with that issuance. And right away, the models that we studied in graduate school aren't supposed to don't take that into account. the markets, the fully functioning markets, certainly the public markets. And there might be other markets that are less liquid, less smooth. But certainly the model in the economist's mind of the public markets is much more efficient. And you have to ask yourself, well, what in the normal, and that, by the way, that's in a normal market, right? And so you've got these really interesting dynamics going on that when you've got sort of the right intellectual curiosity about the subject, you say, you want to learn more. What is going on here that drives markets to be, even the best markets, the most theoretically fully functioning markets, to be that costly? And so you peel back the onion a little bit, you spend some time talking to people, you spend some time doing transactions, and you realize that a lot of it revolves around two fundamental facts about the markets. One is there are huge asymmetries of information. Okay, and we spent, to the extent that you spent time in advanced corporate finance, hopefully we spent some time teaching these concepts, but the notion that there are insiders and outsiders, that there are people who know things about the markets that are different, that have a different fact set, a deeper, richer fact set than others, is something that's endemic in the markets. And that poses challenges every time a trade takes place. And so let me give you an example. If you were to try to trade 100 shares, pick your favorite stock, 100 shares in the market, you pick up your broker, and that is what by the way, that is what the economists had in mind when they're thinking about the markets in their world. You pick up, you say what's IBM trading at? And they say whatever it is, I don't know, 110, 120. You say, all right, well, I want to sell my shares at 110 or better. Done. They give you a call back, literally, it's potentially in minutes, seconds even, and say you're done. Now, when IBM tries to do the same thing, but not on 100 shares, but on 10 million shares, 100 million shares, you have a very different dynamic. That dynamic is not something that's captured in the models. And that dynamic is, well, hold on a second. First of all, but by the way, these are very big markets. Trillions of dollars flow in these markets every day. Of course, IBM has a different position. It's that IBM has knowledge about its shares that the average person who picks up the phone and tries to sell 100 shares doesn't. And so right away it sets up a question about, okay, well, you know, what does IBM know about its shares? How do I need to think about this? Why are they selling so many shares? You know, it's an unusual event for IBM to do that. My favorite example of this, it's a somewhat dated example, but it's one that academics use, is AT&T in 1983 surprised the market and announced that they were going to do a $1 billion equity offering. Okay, and their market capitalization at the time fell by $2 billion. So AT&T announces they're going to raise $1 billion, and their market cap falls by $2 billion. Look at the implied cost of issuing that equity, of course, is huge. It's actually infinite. And so you have these odd dynamics. Once you introduce the notion that there's information in the market that's not fully disseminated into that market, you've got quirky things that happen. So that's the public markets, even in a good market. But let's sort of review history here, recent history, and take the example of I don't think there's any better example of a New York Stock Exchange listed company that seems to be very well known to the markets, Goldman Sachs. Okay, Goldman Sachs, you would think, is the classic example of a liquid, very well known issuer in the stock markets, shouldn't have any problem accessing public capital when it needs public capital, correct? Okay, well then the question you have to ask yourself is why in 2008, when they needed capital, they needed to go to a private source, a private equity model of capital issuance and raise $5 billion from Warren Buffett. And obviously wasn't your typical period of time, wasn't your typical set of circumstances, but it does beg the question. Okay, the public markets are supposed to be fully functioning, very liquid, and they are liquid. Literally, the day that the announcement happened, you know, billions of shares traded. And of course, the issue there is that opacity that I just referred to in information. The question is, what's going on behind the veil at Goldman that I don't understand, that somebody, in this instance it was Warren Buffett, thought, rightly or wrongly, he knew and was able to value shares, have the confidence to value shares in a way that allowed them to transact in a way that the markets writ large were unwilling to transact. So a very interesting dynamic here. Even in the best of times, but even in the worst of times, you have these acute dynamics going on in the market. And if you look at the private equity, the private equity business, which is my day-to-day business today, of late, and I think of private equity, not only my business, which is late-stage buyouts, but also all the other various forms of private equity. Venture capital is the other one, the big one that comes to mind. It's doing exactly that. It's sort of figuring out companies that are very difficult to understand for the public markets and making investments that allow you to do, it's an alternate model for investment, right? If you think about what we're trying to do, we're trying to, sometimes in my class, very flippantly, and I must be careful about this, I say that private equity investors are legally insider trading. Okay, what I mean by that is the average public investor, if you think about what the average public investor has, they get a 10K, as many 10Ks as you want, quarterly reports, and a couple of other financial pieces of information disclosure, including an investor presentation that you can pull down off the web. And that is the basis on which the information set that you have to make a decision as to whether buy, sell, or hold, right? And it would be a dereliction of your duties as a private equity investor, as a venture capitalist, to invest on the same basis, okay? There is not a chance that you are doing your job well if all you are doing is taking that quality, that level of information, and making investment decisions on that, just based on that information. And so you have this really interesting dynamic in the markets, in particular the private markets, that we all need to think about. What is it that sort of creates the private equity model, broadly defined private equity model? And what is it that exists out there in the real world, in the public markets, that creates the opportunities that it does for folks like me, for folks like Kleiner Perkins, to pick a name. So some really interesting things. I look forward to the dialogue, but I just sort of thought I'd throw that out there. Laurie asked me to talk about the public and private markets, just as food for thought to start the conversation.
Thank you, John. Our next panelist is Patricia Moraes, Columbia MBA class of 1995, who is co-head of investment banking in Brazil at J.P. Morgan, focusing on strategic advisory and capital raising projects for Brazilian clients. She's been involved in the execution and origination of several M&A, equity and debt transactions, and is also experienced in cross-border transactions. She received an undergraduate degree in economics from the Pontificia Universidade Católica in Rio de Janeiro, Brazil. I think I just said that with a French accent. Patricia is a member of the Program for Financial Studies Executive Advisory Board. Patricia Moraes.
Thank you. When Laurie talked about this topic, I thought, to bring a little bit of the emerging markets angle to the subject. I mean, what are we seeing? Today we're seeing, especially in the U.S., that the macroeconomic uncertainties are really impacting valuations. If you look at the PE of S&P 500 has been the lowest in a long time. I think 2012 PE is estimated to be 12.2 times, which I'll show you that is in line with what is the expected PE for the Bovespa, the Brazilian exchange, which is quite amazing. And what has been happening? I mean, it's incredible because companies, the corporate world, as we heard before, is well capitalized, balance sheets are strong, profits are strong because people rationalized during the last crisis. So companies are starting to think, what am I going to do with this cash? And of course, the first place to look at is growth. So companies are looking at growth. Companies are looking at spin-offs for corporate clarity. Of course, raising debt in such a low-cost environment. And sometimes, if there's no anything else to do, share repurchases and special dividends. So what has been the impact for Brazil and emerging markets in this scenario. I think that first, given that the risk-free rate now is a question mark. There's no. I remember doing valuations in Brazil that we had to put the country risk at 1,000 basis points in the cost of capital, which is pretty amazing. Just to give you a sense, Brazil country risk now is around 140, and Italy's is 400. So it's what is the risk-free rate now for M&A valuations? Nobody knows the answer. So I think with that, with the strength in the FX, given that most of the emerging markets economies are commodity-based, and FX and commodity prices, as we all know, are up, and these countries have their FX valued against the dollar. What has been happening is that M&A valuations have been converging. And what we see is that a lot more cross-border deals are taking place in a more balanced valuation. So the multiples are converging. So I've been working a lot of deals of foreign companies coming to Brazil, especially to look at the internal market, either the commodity, to explore the commodity markets, oil and gas, mining, but also consumer products for local production. So a lot of U.S. companies looking at that and paying valuations, honestly, that I cannot justify. And that's for the strategic growth prospects of the companies. The other market that has been impacted is the equity markets. I mean, investors do not have growth anywhere, so they like stories with growth. And they have been, even though emerging markets, equity markets have suffered, a lot of the companies that have the growth prospects are trading at much higher multiples than their counterparts in the developed world. Just to give you a sense, earlier this year we did the IPO for Arcos Dorados, which is the McDonald's subsidiary in Latin America. They trade at 13 times EBITDA, whereas McDonald's trades at 9, 2012. Walmart in Mexico, Walmex trades at 14 times, whereas Walmart trades at around 7 times, 2012 multiples. So in an interesting way, I think that the uncertainty, in the developed world and the growth, the expected growth in the emerging markets, it's really gearing the interest towards, and valuations are converging, which is something we discussed about, and that's what I'm seeing that's going on.
Thank you. Our next panelist, Prem Parameswaran, Columbia MBA class of 1995, is a managing director and America's head of telecom in the Global Telecommunications and Media Group in the investment banking division of Deutsche Bank. He advises clients including mergers and acquisitions, privatizations, and public and private equity and debt financing, having executed more than 140 transactions. He received a BA from Columbia University. Prem sits on the board of the Columbia University Alumni Trustee Nominating Committee, has established the Prem Parameswaran Family Scholarship at Columbia Business School, and is a member of the Program for Financial Studies Executive Advisory Board. Prem Parameswaran.
Thanks, Laurie. And thank you all. It's great coming back to Columbia, both having been an undergrad as well as been at business school here, and I think I probably share all of your sentiments because my guess is probably 90%, if not 100% of this room are all CBS grads or have an affiliation with the university. And it's certainly fun coming back, and it's also, from an experience perspective, when you think about, and Erskine mentioned it in the keynote address, when you think about, where you are in your careers and your life, the Columbia infrastructure certainly has helped me. And I'm sure it's helped a lot of people in this room. And when you think about that, it's a very special place. And I always welcome the opportunity to come back, even when it's to recruiting. And I do a fair amount of that at Deutsche, and I used to do it with Laurie. So it's kind of fun. I have about 20 years of investment banking. I now, as Laurie mentioned, run the Media and Telecom Group at Deutsche Bank. And, it's interesting because when I think about investment banking today and, what's going on with the world and what's going on with financiers and how people are viewing investment bankers, you know, it's interesting because I love investment banking, and I'll tell you why. And then I'll get into what I think are some of the pricing dislocations in the market. But the reason I got into investment banking was really to help build companies, right? We help fuel the growth of America and quite frankly, the world, right? We help raise capital. You know, John was talking about IPOs, and we can talk about the pricing dislocation IPOs, but at the same time, we're raising the capital for these new emerging companies to actually build out a plan. You know, Groupon went public yesterday. We can talk a little bit about that in the Q&A, and it's very interesting, right? But these are the new technologies, and you know, Erskine talked about intellectual capital, right? This is good. We need more of this. You know, there is an interesting dichotomy too between the new media, new internet companies, i.e., like the Groupons, like the Facebooks that could be coming public. You know, you can take a bet on over and under $100 billion valuation, versus the old school companies like a Time Warner, like an AT&T, and it's very interesting. You know, and who are going to be the winners? Who are going to be the losers? You know, how we look at today's environment, and this is very interesting because there is a pricing dislocation. The financing markets are open and closed, and a lot has to do with some of the events that are going on, right? In May or June, you could have probably seen what was going to happen in August, right? We knew that we had a debt crisis. We knew that both sides of our political system were at polar opposites, and we knew there probably wasn't going to get a deal done. We also knew Europe was in a world of hurt, right? So if one was a wise investor, one would have shorted the market and could have made a ton of money. And a lot of people did, and a lot of people got burnt. Personally, I knew it, and I didn't take advantage of it. And a lot of people do that. You see it, but you don't take advantage of it. So it's kind of very interesting. I think when you look at M&A today, and that's what Laurie asked me to talk about, you see companies, and I'll talk about two specific deals. The AT&T T-Mobile transaction, which was announced, and there's a lot of news and press about it and whether or not it gets done or doesn't get done. And the second is a smaller transaction, but still, you know, a couple $2 billion, the Windstream Paytech transaction. Both those deals required a ton of capital, quite frankly, in a time where capital is not abundant, let's just say. So, for example, companies that have credit ratings BB or north, so investment grade or just south of investment grade, double B, you have access to capital, granted at higher rates. Anything south of BB, tough to get acquisition financing in harder environments like the one we're currently in. So a company like AT&T, all right, what did they do? They took advantage of a pricing dislocation. They also knew that from an industrial logic perspective, acquiring T-Mobile made a ton of sense. They also looked at it from a competitive standpoint, and that's obviously being judged right now with the regulatory framework as it is. But they looked at it as, here's an opportunity for them to become the world's #1 wireless company, or the U.S.'s #1 wireless company, overtake Verizon. 2, T-Mobile basically was on the same platform as AT&T, so from an industrial logic, it made sense. 3, and this goes back to something that Erskine talked about, investing in rural areas, investing in rural broadband. They said, and they're going to, invest $8 billion and go to 97% of the country and put wireless broadband into the country. President Obama said, as well as the commissioner of the FCC, Janikowski, said they want to go to 98% of the population with rural broadband. So it's very interesting because this is going to get political pretty soon. So now AT&T is basically in target with some of the things that the president as well as the FCC has said. And finally, what's interesting is the unions. So T-Mobile, not a unionized company. So all of a sudden, you're going to add a ton of new workers to the unions. So the unions are in favor of a transaction. So it's very interesting. So you have this political environment that's causing potentially pricing dislocations in the market, but also what's going to happen is going to be very political going forward on how this deal gets passed and if it gets done at all. So you have justice now, for all of you who don't know, the Justice Department potentially may and is suing to stop the deal vis-a-vis competition. Having said that, what I think is going to happen, because it is going to get political, and this goes back to a little bit of what Erskine said earlier, this deal will probably get done. AT&T will do some divestitures. They'll find another fourth party to do those divestitures. And you're going to see a deal get done that should have get done because it's from an industrial logic perspective. The second deal that I want to talk about is Windstream Paytech. Here, a company took advantage of companies that usually trade, and Patricia talked about this. Companies, there's peak multiples, trough multiples, and then in between. And we're in that almost in between level. So telecom companies, media companies traded somewhere close to 10 times. Now they're trading closer to five times, 5 to 6 times. Where they're probably going to go as the economy normalizes, and that may be 2 years from now, a year from now, is probably closer to 7, 8 times. And Windstream had an opportunity to get a company at 6 times. Post synergies at 4.5 times. It's a no-brainer, right? And they had access to financing. So from that perspective, it was very easy to justify. And we're going to see more of that. Now, having said that, given that there is a pricing dislocation, there are many companies who don't want to sell at multiples below where they think they're valued. So what's going to happen, we're going to see more stock deals, right? So that they can participate in the upside of the synergies, potentially. I think it's a very interesting environment. I think we're in this show me environment. There's show me, tell me, and I think people want to see results. And we're going to see that for at least another 18 months, maybe a little less, but it's an interesting time, and I think there's going to be some pricing dislocations, but I also think that we're going to see some interesting M&A transactions come over the next 18 months. Thanks.
Thank you, Prem. Our final panelist, Daniel Wolfenzon, is the Stefan H. Robock Professor of Finance and Economics at Columbia Business School and the Research Director of the Eugene Lang Entrepreneurship Center. He teaches the core class in corporate finance. His research interests are in corporate finance and organizational economics, including corporate governance, investor protection, and ownership concentration. He received BS degrees from MIT and a master's and PhD in economics from Harvard. Daniel Wolfenzon.
Thank you, Laurie. So, thank you for inviting me, and I'm really honored to be sharing this table with such a distinguished group of people. So, Laurie asked me to talk about the effect of uncertainty on capital expenditures. As Laurie said, I'm a professor here, so my talk is going to be a little bit more on the academic side. I hope this is not code word for boring. So I think that capital expenditures, it's quite important. It's a very important question, as it's mostly a very important driver of growth and employment creation. As Laurie said a few minutes ago, and as the keynote speaker mentioned, it seems that companies are accumulating this amount of capital in their balance sheets, and they don't seem to be kind of moving. Even Erskine said that capital is on strike. Right? So a little bit of what I want to do today is 3 things. I want to give you a little bit of a perspective of what is going on with capital expenditures by corporations. I just want to kind of throw out 2 ways in which economists think about this. I'm going to be very brief about it. I don't want to make it a lecture on corporate finance. And then third, I'm going to try to bring some evidence to show whether it's really uncertainty and perhaps not a low aggregate demand that is driving these effects. Okay, so. In terms of trends in capital expenditures, if you look at the data from, for example, the US Census, you find that capital expenditures have been coming down. Okay, so in 2009, there was the lowest number in 5 years. And if you look at the change from, let's say, in a 10-year period from 2000 to 2009, total capital expenditures have decreased by around 7%, okay, which is pretty striking. Now, what is important is that, for example, this decrease is not uniform across sectors. So there are some sectors like mining, utilities, healthcare, where capital expenditures have increased, and there are some others like information. This includes publications, broadcasting, telecommunications, where capital expenditures have been coming down, and also manufacturing. Manufacturing has been coming down over a 10-year period, and this has been especially concentrated on durable goods. Okay, so I think that's kind of, broadly speaking, the main trend in capital expenditures. Now, there's been a recent debate on whether this is driven by low aggregate demand or by an increase in uncertainty. Okay, and if you think about, and this is the part that I want to do short, I don't want to bore you with this, but if you think about what we teach our MBA students in their first corporate finance class, we teach them you should invest when the present value of the cash flows exceed the investment cost, right? And one explanation for low investment could be, well, aggregate demand is low, these cash flows are low, you should not invest, you should just keep the money in the firm or distribute it to your shareholders, as Patricia was saying here, right? Now there's a different explanation for why companies are not investing, okay? And this is something that I'm sure Laurie teaches, and maybe John, you do that as well in your class, which is the view of investment as options. So companies do not only decide whether to invest now or not, and then not invest forever, but they can keep the investment and wait until next year and see whether things improve. Okay, and if you think about that choice, uncertainty plays a big role here, right? Because when uncertainty is very small, there's no uncertainty, you don't gain anything by waiting. Low uncertainty means that the world is going to be like it is today, so there's no role in waiting, right? But when uncertainty is huge, and if you wait, and if the conditions in the market deteriorate, you really avoid a really, really bad outcome, right? Whereas when demand is strong, you can always, have the option to invest, okay? So one of the reasons, I think, why we are seeing these, capital on strike or low investment in capital expenditures is because, corporations are taking this attitude of, let's just wait and see what is going to happen, okay? And this is, by the way, this is not something that is particular about this period of time. I also looking back at other periods where we've had, and I'm looking for the quote here, where we have like increased level of uncertainty in the market. For example, right after September 11, the Federal Open Market Committee, made this statement. The event of September 11 produced a market increase in uncertainty, depressing investing by fostering an increasingly widespread wait-and-see attitude. Okay, so that's one way to interpret what is going on with capital expenditures, just corporations and sitting there on this cash and just waiting to see what is going to happen. Okay, and as a result of this, issues like uncertainty in the global economic environment that is very difficult to change, but also regulatory uncertainty, political uncertainty, these might all be affecting decisions to invest. Okay, for example, I don't really know what my tax rate is going to be 2 years from now. Okay, that is a big issue for me when I'm thinking about my investment. Okay, I prefer to just wait and see. Similarly, I just to tell you a story, I was in Spain this summer, and we were thinking about making a small investment in real estate. We managed to find something that looked like a good price, like a good deal, but we decided to wait, right? Things can get worse, and we can get it at an even better price. Okay? So that's kind of the idea. Now, let me just briefly mention one thing. If you think about periods of uncertainty, they are usually periods also, if you look back in history, are also periods where we've had low aggregate demand. So if you really want to tease these two apart, whether you want to say, is capital expenditure lower because of uncertainty, or is it lower just because the aggregate demand is low? I mean, this is very difficult to tease apart. And I just, decided to I was doing a little bit of research on this before coming here and see whether there's any evidence that there is really a big effect on uncertainty on capital expenditures. And I found this very nice paper, actually, that looked at electric utilities. Okay? The nice thing about electric utilities is that their cash flows that are driven by weather, by the weather conditions. And before 1997, there was no way to hedge this risk. Okay? Weather derivatives were not around. And as a result, these firms had relatively low levels of investments. When in 1997 derivatives were introduced, weather derivatives that allowed these firms to hedge this weather risk, you actually saw that these firms used these derivatives to stabilize cash flows. And once these cash flows were stabilized, investment increased by quite a bit. Okay? And by the way, also valuations increased. So I think there is a very tight connection between uncertainty and investment, capital expenditures. Now, if you ask, looking for more information, again, I don't have the personal experience that you guys have. My experience is just the papers that I read online. There is also a number of surveys asking business owners, and these guys do mention that uncertainty about the future, it seems to be a very important concern for them. Okay? Now, I don't mean to say that low aggregate demand is something that is not important for investment, but I do think that uncertainty is really depressing demand, and it seems to be for this kind of wait and see attitude that corporations are taking to investment. So that's what I wanted to say.
Thank you. It's interesting that many of our panelists have commented on changes that they've witnessed in recent years. And so as a follow-up, I'd like to ask each of them, which do they perceive as temporary and which do they perceive as permanent shifts in paradigm? So if you please.
Well, there are a couple things we can ask that question about with regard to each of what the panelists have said. With regard to my own comments, I will say this: the reality is, the public markets generally are have challenges. Even as I've said, even in a good market, there are these frictions, these very significant transaction costs that need to be dealt with. Investment banks play a very big role in that. I would say other financial intermediaries can play a role in that. Rating agencies, when they're playing their role well, have a role in that, as well as other institutions. So, so there are these frictions, and there's a reason for financial intermediation that I don't see going away anytime soon, notwithstanding what's happening in globalization, technology, whatever else you want to say. On the other hand, some of these other more specific items of these specific dislocations, whether it's Goldman Sachs having to go out and raise money from a private equity investor, or Daniel mentioned some of the uncertainties around deferring capital investment because of uncertainties and risk. I think over time, one would hope that we come out of this and we find this very acute period of uncertainty. On the other hand, much of this uncertainty is self-induced. What I mean by that is government-induced. So every time the government has to come out, whether it's this government or any other government that has to come out and sort of say, we may change things, we'll tell you when we do, and then goes back behind closed doors for weeks or months at a time and sort of says, and where the outcome is uncertain is clearly an environment where you're going to see low investment. And I don't know whether that, and perhaps people in the room do, have a point of view as to whether that will be for months longer, quarters longer, years longer, decades longer. But certainly that is one of the sort of the key features of our current environment when it comes to investing in valuation, for sure.
Patricia.
I think that what's permanent and is the comfort that companies are getting out of their countries and investing abroad. I think this is a trend that is increasing, and companies are seeing value and are learning how to work outside of their comfort zone. Both ways, emerging markets coming to developed markets and developed markets coming to emerging markets. What I hope is temporary is one thing that also happens in emerging markets, which is the political impacts on certain transactions, that can skew things in different ways. I hope this is temporary. So I think that you know, having, for example, in Brazil, not having long-term financing, so having a lot of the transactions sponsored by the development bank. I hope this is temporary, and I hope that people can get more access to long-term financing, but that's a process. So I hope that the U.S., this is also temporary, Prem.
Yeah. Yeah, no, you know, it's funny because it goes back to something I said. You know, we're in this show me mentality right now, and show me environment. Having said that, you know, what's permanent, what's temporary, you would assume that markets are efficient. Over time, they will revert back, right, and get to a normalized market, if you will, and multiples get back to normalized multiples vis-a-vis growth and where they should be on a growth trajectory. Having said that, the uncertainty here is regulation. And that's the one thing that Erskine actually did not mention earlier. You know, Basel III in Europe, that is going to cause immense capital restrictions on investment banks globally and banks globally. Here, our own capital requirements through this credit crisis has caused banks to redistribute kind of their capital, as well as look at prop trading, as well as other ways that banks traditionally had made money, you know, and shut them down. And so that changes the paradigm. It changes the model. Private equity firms normally looked at, you know, 20+% equity returns. That's hard. That's going to be hard in this environment because capital is not the cost of capital is a lot more, and it's not available to all these companies. So, you know, you would hope that most of this is temporary, but I think the regulatory aspects make some of this, especially on the banking side, permanent. And you know, you look at I looked at when I started investment banking, you know, 20 years ago as an analyst, you know, and you looked at, you know, a career in investment banking, there was a huge amount of wealth creation. It's a lot different today, and you know, it's certainly a different paradigm shift. And I think the same can be said about private equity. Having said that, the private equity firms today are not regulated the same way banks are. So where do I see growth or invested capital going to form capital markets or M&A organizations within? I see that happening in the private equity. And we're already seeing it, the KKRs, the Blackstones, they have their own capital markets divisions right now, and they also are starting to put together corporate finance divisions. So it's very interesting.
So I want to just comment again on what John was saying. I think it's super interesting the fact that even government policy, even regulation, that you might think a regulation that might be pro-business. Let's say that we decide that we're going to lower taxes on businesses, but it's going to take us 6 months to get there. That could be counterproductive. That's kind of relative, you know, it's very, very close to what I was saying, and I think that there is this type of, especially in these times with so-called, you know, the polarized political system, you know, even regulation that might benefit business might have this effect, which is by creating uncertainty, it might delay investment. The other thing that I wanted to say, which when I was thinking about these questions about uncertainty, you know, what is the uncertainty that we are facing in the market? And we are facing a lot of uncertainty now. But one thing I did kind of was to look at the, for example, the VIX index, which is an index of the implied volatility of the S&P 500 index. And if you look at that index and you compute an index similar for, let's say, Germany, and you look at these two series, what you find is that they are moving together very closely, which might imply that, you know, the risks that, you know, at least the market is capturing in the US are risks that are global risks. So it might seem, for example, that, you know, a lot of it is coming from Europe. And, you know, who knows? It seems that, you know, I don't have a lot of confidence of what is going to happen there, but at least it seems that it's going to be over soon, one way or the other. So that might, you know, that might reduce uncertainty. I mean, it might increase aggregate demand, of course, but.
I'd love to open it up to questions from the audience. Do we have any? If you'll come up to the microphone so we can all hear you, that would be terrific. There you go.
found this discussion very interesting. I'm Paul Elver, I'm class of 70. I was an investment banker for 26 years at Morgan Stanley, a good part of the time. I now run, I somewhat jokingly call the family hedge fund, but I also serve on public company boards. But there were a couple things that were triggered by John, and actually Prem mentioned it. I learned my corporate finance first under Burt Malkiel in 1964. Now, I don't know whether that's a name that rings with all the young
You're random walking down Wall Street?
Still, I think he's in the 80s. I saw him last year at Princeton. I think he still believes in the efficient market. And that's one of the questions I want to ask, but it relates to something John mentioned and all these dichotomies in pricing in the public market. But let's take the Goldman Sachs Buffett transaction. I don't own Goldman Sachs, but if I had to own Goldman Sachs, I would have been very upset by that transaction, which potentially is massively dilutive to the common shareholder because it's a preferred with a strike price, so I guess it was basically at market. I maintain that if they did, say, a rights offering for the public shareholders who own the equity would have bought that, maybe at 8% plus 15 or something like that. I don't know the exact numbers. Why didn't they do it? Well, obviously there are regulatory issues. The board probably said, we can do this very quickly. The other thing is, were there disclosures that they might have to make in a public offering? And then my question is related to what John said. Well, did he get, when he did his due diligence as a private investor, did he get information that the public market does not have? I don't know the answer to that question. But if he did what John said and was responsible private investor, I'd say the answer is probably yes. So these kind of dichotomies, to me, undermine the concept of the efficient market. So I'd just like a general comment on whether the academics are still teaching the efficient market concept. I don't believe in the efficient market, and there are equal opportunities to both make a lot of money and lose a lot of money, because I don't think the market is efficient, frankly.
You guys want me to start with that one?
Sure.
I'll answer the academic view and then maybe the practitioner's view as well, since I've had the opportunity to wear both hats in my career. When we learned the efficient markets hypothesis, in particular the work of Fama, differentiated different levels of market efficiency. A strong form efficient market is all information, public, private, and otherwise, is already incorporated into the price. What he referred to as a semi-strong notion of market efficiency was that all publicly available information was in price. And by the way, that would be consistent with insiders systematically being on the right side of a trade. And then there's a weak form of efficiency that has even less information in it. I think the academic literature, by and large, would argue that the evidence is clearly against the strong form efficiency argument. Specifically, if we look at insiders' performance, they do systematically better. And that would be inconsistent with a strong form efficient notion of market efficiency. The semi-strong notion, I think, is probably about where most academics would say the literature is. It then becomes the question of what is information, and that's actually something I'd like to comment on. Even in my career, I think the notion of what information is has changed dramatically. When I was early in my career, it was about getting access to information. There was this notion pre-Reg FD, for example, some people were told things in a private room that other people weren't told, and a lot of the regulatory environment was trying to reduce that discrepancy. I now suffered in my practice career with the opposite problem. There's too much information. There's such an abundance of information that I now think the skill, or that which is rewarded, is not just access, but also how we understand it, how we incorporate it, internalize it, and figure out what it means, given this whole huge overabundance of information, to determine what really is important, what are the key value drivers, how do we prognosticate about what the future will be, and therefore decide whether something's a buy or a sell, to simplify the statement. So I hope that gives just a brief introduction to where I think the academic literature has moved in terms of the notion of market efficiency.
Yeah, so the academic literature, and what Laurie's referring to now, is sometimes in the academic literature characterized as noise, right? So yeah, I'm reminded of Donald Rumsfeld's, sometimes there are known unknowns and unknown unknowns, and et cetera, right? And so You don't know, if you assume that there are these pockets of information that are being traded on, but you then don't know who is trading on that information, other people look like they may be trading on that information, you've got a lot of trading based on noise. So, right, you know that there are some really smart people out there who may even be trading on insider information. And you've got people out there who look like they're trading on insider information. And you don't have any of that information, but you're going to trade based on what looks like insider information. And other people are going to look at you and trade on that because you look like you're trading on that on insider information. You get this really weird and frothy market, which I think loses its sort of the notion of efficiency with a capital E. By the way, I use the word efficiency in my remarks when we're talking about big transaction costs with a small e. In other words, you don't really think of transaction costs being that big in a efficient, with a small e, efficient market. To the point that was made earlier about, and by the way, anything that I say as a private citizen and an affiliate of Columbia Business School, and the views that I hold are my own, not of the institution I represent. Let me just make that. Let me make that a very important disclosure, particularly as we're about to wade into talking about Goldman Sachs, institution which I'm very fond of, and have my own history in. So, you know, by the way, Warren Buffett. It's back to information. It's very difficult for me to sort of be able to justify Warren Buffett because Warren Buffett comes out and he pretends. Maybe he claims, he asserts that he doesn't do much in the way of due diligence outside of just picking up the phone, talking to the CEO, and reading over some of the public available information. Now, if that's true, he's a real puzzle to me, okay? Because we kill ourselves, absolutely kill ourselves, with all sorts of due diligence, even when we're looking at these public investment opportunities. And we still have a tough time feeling like we can generate alpha, okay? And Warren seems to make it look effortless. So maybe it's true, he's just smarter than everybody. But I suspect that behind that very folksy facade of just sort of, good, fundamental wisdoms and truths as being the driving force, he's also got himself access to information that we might not necessarily have. Presumably, to the extent that he has, that information gets disclosed in proxy statements as he's making these investments. And again, I'm not as intimately familiar with the inner workings of Berkshire Hathaway, but there have been stories about it. So I'll just leave it there, and I don't know if anybody else has any comments on that specific situation, but.
What do we got?
I was going to say it's an interesting question on Goldman. And I think, and by the way, having been at Goldman, I'm still a shareholder of Goldman, so appreciate the comment. But it's interesting. It's the old classic analogy, and this also can relate to M&A, of a bird in the hand, right? So remember, when Warren originally made the first investment, it was during a time of turbulence, right? So all the banks were looking for capital at that time. Warren, who, as we all know, is a Columbia guy, so that's also another ringing endorsement for our school. But the world's foremost investor is saying, I want to bet on Goldman Sachs, right? Versus doing a rights offering, which there's time, there's uncertainty, and time was time was of essence in that period, in that credit crisis time period. So getting that deal done, as a board, as a public board, I'm sure there was enough diligence that was done, and I'm sure that was on the table. A rights offering, I didn't look at the disclosures or the proxy, but I'm sure that was part of the discussion. Interesting enough, I mentioned the the Windstream Paytech transaction, and it's interesting because there was two bidders that came over the transom during our process, right? And it was an exclusive period. And we went and one came in the night before we were about to announce a transaction. And it's very interesting. We went into the board. We had to reassemble our fairness committee because we had to take all of that into effect. And it was a 60% higher offer. And so, as you know, when you're sitting with a public board, you have to disclose every fact and say, look, should we investigate this? And again, it came down to bird in the hand. you announce a deal, you have the deal at certainty. You know, as time goes, it was interesting. That deal was announced at the end of July. You know, the markets tanked 2 weeks later. That follow-up bid, and I can't disclose the company, probably would not have amounted to a transaction. So I think the board made the right choice. But again, going back to your specific question, I think it's interesting. I think as a board evaluates opportunities, I think timing, so when you talk about efficient markets, I think there are times where you can take advantage of a market and take advantage of market dislocations, but over time, I still believe that kind of markets normalize.
I have nothing to say about the Warren Buffett Goldman Sachs transaction. I wanted to just talk a little bit about the question about do we still teach efficient markets? And I agree 100% with what Laurie said. And I also wanted to add that there is a group of researchers studying what is called behavioral finance. What that is, and actually we offer classes on that on that subject to our MBA students. And essentially, what it is that investors have psychological biases. These psychological biases essentially do not cancel each other out. They are kind of tend to go all in the same direction, and for that reason, we observe sometimes deviations from what you would call a fair price or an efficient price. So there is this group of people who are doing this type of analysis, and we are, we do offer this class at Columbia. Actually, the guy who teaches it is our neighbor, Laurie, and
Yes, in our office.
In our office, yes.
No, I just had a quick comment. I mean, it's hard to believe in efficient markets when you have a crisis in Europe, and then Italy is going to issue bonds, and China says that they're going to buy up the bonds, and the whole market moves. And so I think it's a time that is really tough to, in specific situations, believe in efficient markets.
Are there any questions from the audience? Please introduce yourself.
Hi, everyone. Good morning. My name is Michael Howe. I had the honor of being a student of Professor Hodrick a few years back. I'm currently a portfolio manager actually at Goldman Sachs. So I've heard all the different stories about it. It's very interesting. The question for you is really understanding the bid-ask spreads and hearing from a bunch of people at the M&A side. So you look at the recipe. Growth is slowing. Interest rates, 10 years at 2%. High synergies. Bid-ask spreads have started to narrow. A year ago, the complaint was, well, it just seems like it's just the next day. It's just the next day. A year ago, it was the bid-ask spreads were too wide. The asking prices were just too much. The rates were too high. You had both of those come down. You had significant corrections in equity markets. You had the 10-year obviously come down. It's tougher for high yield rated companies, but I'm just surprised by that. Why is there not more M&A? Particularly in the investment grade companies. I mean, I can understand more for financials and the higher riskier, but what's the change? I mean, I know there's uncertainty now, but I just want to hear from a practitioner.
I'd be interested in Patricia's or Prem's comments because, the empirical fact, correct me if I'm wrong, academics, is that, merger activity tends to be pro-cyclical. In other words, in good markets, lots of merger activity. In bad markets, none. And it's a really interesting question. I've got a couple of my own thoughts, but I don't know if you guys sort of have your specific ideas.
Go ahead.
So I think it's a great question. And I think the answer to it is a little bit of kind of what we talked about, right? So there's pricing dislocation. So multiples are down, right? Even for investment grade companies, right? So they don't want to sell when their multiples are down, right? So what happens? And there is, I do think there will be, and there is a bunch of M&A dialogue going on as we speak, at least within the media and telecom sector. I can, tell you that I think you're going to see announced deals coming, over the next, call it 6 to 12 months. And I think the interesting thing that you're going to see, though, is you're going to see companies take more stock, right? Because they will say, I don't want to sell at 6 times. I believe my company's worth 9, right? But I'll partake in the upside of the pro forma combined company, and I'll go with you and get some of the synergies as we go forward. So I'll take that bet. I think we're going to see more of that going forward because there is a dislocation right now in multiples.
Yeah, and I mean, from our standpoint, I think what the interesting thing that is happening, M&A activity is not horrible, but it's slower. And I think you have two trends: stock deals for local companies, so a lot of local companies merging, reorganizing, consolidating their sectors. But you're going to see, I think, a lot of sell sides coming out of Brazil, because I think the prices are high. And you see people looking for growth, so they are willing to pay up. And you also see a big, let's say, countries trying to position themselves on the commodities space. So, for example, the Japanese have been long-term investors in Brazil, and now the Chinese are coming, and they want to beat the Japanese, and the Brazilians don't want to let it go. So I think there is already a lot of movement there, but I think sell sides are a big hit. Whereas one interesting thing in the crisis in 2008, when the U.S. companies were weaker and with a lot of leverage, we saw a lot of interest of Brazilian companies coming to Brazil. We actually did a lot of cross-border deals. We looked at a lot of things here because the U.S. was cheaper, the currency was stronger, and the companies needed capital. So that fueled the trend the other way around.
Having been a board member of a public company, I will say this. In addition to the comments that were just made, I think there are two other. One Daniel hit on earlier, which is, there's probably something about the behavior of humans which is less than rational. That probably plays a role. And what I mean by that is there's a decent amount of empirical evidence that shows that people don't want to sell things at a loss, right? So investment bankers will do a whole bunch of studies around what price shareholders have gotten in at to try to understand what the clearing price for a particular M&A transaction will be. So obviously when shares fall, a lot of people have gotten in at a high price. When shares fall, even if you're paying a premium, you might not necessarily clear that psychological hurdle. So there may be a behavioral finance sort of explanation to it. The other one is legal, which is to say you look back on a 52-week high, and you see that your stock was trading at 70. Your stock is now trading at 20, and somebody's offering you 30. The answer to that shouldn't, in theory, be, well, particularly in a more efficient market, is you're being offered a huge synergy. Is the transaction fair? The answer should be yes. By dint of the fact that they're paying you a market premium, it is fair, right? On the other hand, a board will have a very difficult time, and investment banks will have a very difficult time delivering fairness when they have seen a stock price in the last 52 weeks that is significantly higher than the offer price. Now, is that rational? Is that efficient? But the legal risk one bears as a board when you vote for a transaction that is significantly below the 52-week high of a stock is significantly higher. I don't know. I can't put a number on it, but it's significantly higher.
I was just going to add one more observation. If you look for the last century at the merger waves and the trends in merger activity, even though the nature of the mergers were very different across the different periods of high mergers, certain characteristics or correlations are very striking. And one of the most striking is that merger waves very definitely correlate with high investment in what Professor Wolfenzon was talking about earlier, which is real investment, PP&E, capital expenditure, which we're not seeing. And therefore, by that measure, we're not surprised to see not an abundance of merger activity, because historically, at least, those two things are very highly correlated in trend. And we're not yet seeing companies putting that cash out in that use. In a sense, you can buy assets, you can buy other firms and obtain their assets. There's a comparability to those transactions that show across very different merger waves.
Just one last question here, just specifically for John. Just the reemergence of private equity back into the markets. Obviously, the high yield debt has come up significantly, and we still have a pipeline of LBOs that have to come out. But I guess what's your kind of thoughts on when private equity really comes back, turning back into the markets?
There are. I debated whether we wanted to talk about this because it's a big topic. We could have a seminar solely on this particular topic. But there is a case to be made I won't make it, but I'll just throw it out there theoretically, that private equity finds itself in 2011 in the same place that venture capital found itself in 2001. What do I mean by that? The venture capital industry was sized for a market that looked like it was, that the 1999 and 2000 market was going to continue indefinitely. And so you had early stage venture capital firms that had raised $1 billion to go and put $10 million investments at a time. And obviously that's not what happened after the tech bubble burst. Well, you could draw an analogy to that certainly in the mega fund segment of that business, which is where certainly where most of the capital dollars are. That you had $15, $20 billion funds being raised in a market which was appropriately sized for the 2007 market, but is probably mismatched for a 2011 market. You're already seeing that, actually. There's empirical evidence that the LPs have reduced their commitments, and therefore the mega funds are having a difficult time raising. Historically, they had been middle market firms that had grown very, very large, successive funds being bigger than the prior funds. It's clear here that mega funds, the next fund that a mega fund raises is going to be smaller, by and large, than the last fund, which is unusual, but is also suggestive of the point that I just made.
If I may, with our last minutes, I'd like to throw out a hard, open-ended question to all of our panelists, which is, what will be the corporate finance story of 2012? You want me to go first?
Sure.
I should say I get asked questions like that by my students all the time. Those are always the hard ones. When they ask the really specific questions, that's what you hope for. It's those open-ended ones, because then they'll come back and send you an email, either you were right or you were wrong. There's an accountability. Personally, the thing I'm watching is the cash that these companies are holding, these trillions of dollars that corporations are currently holding. And as a person who has pursued a career both in academics and in practice, looking at the corporate uses of cash, dividends and share repurchases and so forth, it's thrilling for me to watch it accumulate and to anticipate when the firms and how the firms will pay that cash back to their shareholders. So for me, that personally will be at least one of the stories in corporate finance in 2012 that I will be watching very closely.
Oh, am I supposed to go next?
Yeah.
Oh, boy. One of the things I'll be watching, I have been watching and will continue to watch through 2012 is the liquidity generated by the Fed. That has been one of the interesting hallmarks of our business since the 08-09 crisis, which is that for a while in 2010, it looked like we were back to capital markets that looked like the 2007. Certainly certain capital markets that looked like they were back to the 2006-2007 ebullience. And my economist hat on, I attributed that to the immense amount of liquidity that was injected into the business, notwithstanding what was going on in the real economy, in the financial economy because of Fed action. It'll be interesting to sort of see what happens, particularly if we find ourselves in the real economy being stressed. And the Fed's reaction to that, which will clearly have impacts, ramifications into credit markets. We saw that in 2010. Question is, will we see it in 2012? It'll depend, I suspect, on a number of things, but certainly Fed action would be one of the big ones.
You got talking about the PEs, and the other thing that is happening in emerging markets is that a lot of money has been raised by private equities. And coming back to the valuation issue, I mean, I've seen things kind of crazy happening. I think, we are a few years back, maybe we are in the 2007 right now in terms of valuations. And I'm curious to see, I think just in the last 6 months, over $10 billion have been raised just for Brazil private equity, which seems way too much in my view. So I'll be curious to see if valuations will continue to sustain these levels, and if just the justification of the growth of the country and the opportunity and the global slowdown justifies companies taking an extra step and paying up, including the private equities.
That's great. I'm going to continue a theme that Laurie said and what I think the 2012 corporate finance, what's going to happen. So Fortune 500 companies are sitting on $2 trillion worth of cash. $2 trillion. They're just sitting on it, right? And I'm going back to something I said earlier about regulation. They don't know what to do because they feel like they're regulated. So if that gets cleared up, there's going to be a ton of capital spent. And so I agree with that. I think the other thing, the bridge to that is industrial logic deals are going to get done over the next 2 years. So what does that mean? Does Disney buy Time Warner? Perhaps. Perhaps. Comcast bought NBC. So industrial logic deals, whether it's media and telecom, whether it's energy, whether it's consumer, whether it's healthcare, whether it's in Brazil, I think industrial logic deals are going to get done over the next 2 years.
I actually want to continue with the same topic. If one believes that what is holding back investment now is uncertainty, and if uncertainty is resolved, we should see more, transactions, both real investments, M&A activities, and that should improve capital reallocation in the economy. So I should see, I would expect to see some effects on productivity coming up in the future. So.
Okay. On behalf of everyone here, I would like to thank our panelists. We have a small gift as a token of our appreciation. It has our logo, and so we hope it's something you'll enjoy. I want to thank everybody in the audience for participating in the inaugural Program for Financial Studies Conference. What a thrill it's been for all of us to be a part of it, and we'll look forward to seeing you next year. Thank you very much.